Hey, good afternoon, everybody. It is January 6th, and this time of year, I routinely go out and encourage business owners to get a hold of me. Now, it's a busy time of year. You're finishing up the holidays and you're finishing up trying to get a handle on where you're at. You're still running your business and you're trying to gather your data for your accountant. So two things. One is you need to get your taxes in ASAP, but before you file those taxes and before you look at your P&Ls, I want to encourage you to talk to people like me. It doesn't necessarily have to be me, but let it be someone who's been around for a while. Let it be someone who's got access to data, comps in particular, um, and get a valuation on your business today. Now, I'm reading a book right now called Walking to Destiny, and it's all about exit planning, which is a certification I'm getting. And it's an interesting concept because business owners and most people think about exit planning as like, hey, I need to quit in the next year or two. Um, let's plan for that. And of course, that's part of it. But the reality is exit planning is more about a way of running your business. So, um, when you think about strategically moving forward and the business process when you were in the corporate world in particular, I remember being at Pepsi doing the planning process. Um, we would spend a week or 2 weeks offsite planning our business in the fourth quarter of the prior year, trying to get a handle on where we wanted the business to go and what were reasonable growth methodologies in the game and war game, what were best in class or targets we wanted to hit. Now, the problem being a business owner is most of you don't have boards. Most of you do not have a trusted group of people. And those trusted group of people you may have aren't necessarily people with business experience at the micro or Main Street level. Think about who your most relied on person is. The book says it's usually your financial planner or your CPA. So I'm going to ask both of you, not both of you, but ask you to think about this and then think about your CPA and your financial planner. First question, when was the last time they had a serious conversation about your performance, reviewed your books, and talked about why you were hitting targets or not hitting targets? And then ask them what their experiences were with regard to running those types of businesses. And then ask them if they have any data they can share with you about what the best in class performance levels are for your business compared to others. So when you think about it, there's very few people other than your competitors who have best in class or KPIs or standards in terms of performance and results that you can go to and say, hey, this is where I am. What's the best in class in the industry? And those people just don't exist. Now, with one exception. People like me. People like me look at other people's financials every day. Now, we're not CPAs. We're not financial planners, but we are attuned to how to read financials, and we've reviewed the performance of businesses. And the longer we've been in the business, the more we have, and we're routinely attuned to lessons learned, crises, best in class, who does things right, who does things wrong, and lessons learned. I'll give you an example. For many, many years, when I was operating over in the Orlando market, I would routinely sell 10 to 15 lawn services a year. I got so good at it at one point that I was the lawn guy, and I had a reputation in the industry as one who really knew that business backwards and forwards, to a point where I write a section of our business reference guide for the Business Brokerage Press. Then I got into property management. I became that guy for them. And you learn certain things about these businesses the more you sell them, because you're inside their P&Ls, you're inside their balance sheets, and you get to look at why their revenue is what it is, and why their margins are what they are, and how they run their labor model. And you get all the feedback from the CPAs who have done the due diligence on them. So, if you think about it, I've sold 400 businesses. I probably looked at close to 1,000. And I've reviewed all their books and records. I did one today. It took me about an hour to go through a set of financials. And then I'd happened to have sold the business 3 years prior, and the guy who bought it tripled it. So I pulled the old files and I pulled the new files and I laid them against each other, and I looked at why certain numbers were different. And then I interviewed the seller. I said, you did it right. He nailed it. He's restructured the company. He changed his internal operations, changed his compensation structure. retargeted the market to get better margins, did all these things. Now think about that. If you were another business owner in that same industry, and for confidentiality purposes, I don't disclose names and I don't tell other people who does what, right? So it's secret sauce. But if you ask me, you come to me with your books and you say, hey, Mike, I'm only making 20%. What's best in class? And I look at your revenue size and I look at your sector and I look at your market. Chances are that I've got some sold statistics or some businesses that I've done or some resources, whether that be from the reference guide, Pratt Stats, or Transworld's internal database, where I can look and go, hey, you're either beating them, you're at them, or you're missing the mark on these particular issues. Some of the other lessons learned we get to look at is, legal issues with structure, i.e., are you running 1099s or W-2s? Revenue concentration issues, some simple accounting tricks like, I think if you watched any of my YouTube videos, you've seen me talk about the 28-day billing cycle versus the 30-day billing cycle and pre-billing versus post-billing and how that helps on cash flow. But what's the point of all this? The point of all this is that when you're doing exit planning, it's not, hey, I'm ready to quit, retire, or sell the company. Exit planning should be a way of running your business every year. Because if you know what your soft underbelly is and you know what you're not doing right, and you have someone you can turn to in a confidential manner to get that feedback, then you can fix it, because you can't fix things overnight. There are some things you can move the needle on. So for example, you have a pool company and your average price per pool on a monthly basis is $90. And I've sold 100 of them more. And I've looked at, God knows how many over the years. And I know empirically and from a data standpoint that the average price per pool is $140 in your market. Well, you're not going to take your customer base and move it from 80 to 140 in 1 year. It's just not going to happen. You'll lose them all. But there are means and strategies and ways to close that gap. And we could talk about that. And we could talk about ways we've seen people do things in the past, so that you're not operating on your own in a vacuum. You're operating with some sort of guide rails about where you need to be so you can move the needle. Now, think about that. Think about that case. Say you were 56 and you need to sell that business because you just got diagnosed with macular degeneration. You're going to be blind in 2 years. And you need that money to, fund your retirement and your long-term care. Well, we may not have the runway to get there. One of the analogies in the book was a meerkat. A meerkat is those little rodents that live on the African plains, and they're like little squirrels, but they get stuck, and you'll see them with their heads moving around really fast, pivoting. And the book said that sometimes owners become meerkats as the closer they are to having to make a decision, and the more variables they get, that deer in the headlights, and then they freeze up. The point of being in exit planning is that if you plan far enough in advance and you identify your weaknesses and your shortfalls, you can address them and improve upon them. No one's going to be perfect. But should sickness, should circumstance, should divorce, should a loss of a customer, should, God forbid, a traffic accident or some familial issues that force you to relocate, put you in a circumstance where you need to have a liquidity event, either sell to your employees, shut it down, or close it. You've addressed the things that detract from value, because value is not just a math problem. At the Main Street level, because there's so many errors and so many issues, people tend to think it's just 2 times cash flow or 1 times cash flow. And that's where these rules of thumb come to pass. And it's usually because the Main Street business owners haven't addressed what we call the 4 C's: human capital, structural capital, customer capital, and social capital. Human capital being your personnel and your staff. Customer capital, how sticky are your customers? Is there a loyalty program? Is there a way to ensure that those customers don't depart during a transition? Social capital is your brand. And then structural capital is, how you're organized. Usually business owners don't address that. Usually business owners are, owner operators, and as such, usually, you'll get, you lose. So say, for example, you're a lawn company, and we're using these simple ones, or you're a restaurant, right? And you're in the kitchen. Well, there's lots of people want to buy restaurants, but not many business owners want to step in and cook behind the counter. And because of that, the majority of buyers who don't want to cook will value a business less. So if you had a restaurant, you made it absentee and you were making better numbers for some reason because you had done exit planning and addressed all your shortfalls, and you kind of made just as much money as you would with working behind the counter, but you had more sticky customers, you had catering operations, and you had expanded hours, et cetera, et cetera, et cetera. If you had done all those things then and eliminated the bullet holes that someone's going to throw at you as a buyer, or those red flags that are going to pop up because you didn't address them, then you're in a better defensible position to sell when you have to sell. And the pricing and the terms are not being dictated to you by circumstances outside your control. I call it 3 little pigs syndrome, right? We all know the story of the 3 little pigs. Build a house of sticks, build a house of mud, and the guy who builds the house of bricks, right? The big bad wolf is coming. They're going to come, and they're going to huff, and they're going to puff, and they will blow your house down unless you've built something on a strong foundation. So for the love of Mary, starting today, I don't care if it's me, I don't care if it's somebody else, get with a business broker before you file your taxes every year. Review your performance to prior year, have them review your performance compared to best in class in your industry, to like type businesses. Don't ask them to tell you who the other guys are, because they can't and they shouldn't. But they should be able to articulate to you what you're good at, what you're not good at, and what you need to improve on, and what's actually best in class. Twice I've seen best in class, nothing to do. Twice. And when I think on those people, one of them was just last year. It took her 20 years to get to a point where she was perfect. And when she was perfect, she sold for a higher multiple than she probably would have otherwise. Do that planning every year. Do it before you file the returns, and respect the time of those people, because you don't need to pay for it, but they should be in your pocket as an advisor, and they should be someone that you can pick up the phone and go, hey, am I doing this right? The other time I did it was a lawn guy who I worked with for over 15 years, who every year we would review his labor. When he felt like he was off the mark, we functioned much like a sounding board. It was in the green space because I had been one of those guys who'd done a ton of them. And when it came time to sell, we got a premium because he had better margins than most. If you want to reach out, my contact card is the QR code. Just scan it, or you can call me at 321-287-0349. Have a good one.